listed investment companies were seen as the hot thing a few years ago, but now most LICs are trading well below net asset value. To help us unpack that space, Frank Danieli from MA Financial joining us now. Again, Frank, good to see you.
Good to see you again, Andrew.
All right, so LICs, as I mentioned there, they were very popular, but certainly less so now. So what's happening in that space at this point?
Yeah, it's really interesting. I was looking at the ASX data on this space the other day, and in fact, at the moment, 80% of the listed investment company universe is currently trading below net assets. So that basically means that you can buy the shares in these managed funds on the ASX for lower than the value of the assets in the fund. And that actually sounds and seems pretty attractive, right? Because it's almost the ultimate Ben Graham value investor style opportunity, the opportunity to buy $1 for 85 cents. And but I think there are some challenges in this space, and one of the things that we do notice is that just because the share prices are trading below net tangible assets, or NTA, doesn't mean there's a catalyst that they'll revert to net assets. And so investors in this space do need to be careful, because there could we think, be a little bit of a trap there.
A value trap, which goes to that question of how you actually value these.
Yeah, and look, it's really interesting, because there are different types of LICs. Some of them are equity managed funds, and there for sure the value of the underlying assets, because the assets are a portfolio of equities, and they trade on global stock exchanges. And some of them are private market vehicles or private credit, other types of unlisted assets. And there you are at the mercy, if you will, of the fund manager and their approach to valuation for those particular assets. Interestingly, it's both in the equity side and in the credit and alternative side, you actually see quite a meaningful discount to NTA in this space. And I think that shows actually that there seems to be, at least in Australia, some sort of structural issue around this space, which is that they trade quite a lot below NTA, and it's hard to see what the catalyst might be, particularly in a rising rate environment with a bit of economic volatility that could actually lead that to revert.
Okay, so that's LICs. Let's move to bonds. Now, it hasn't been great, certainly over the past 12 months or so. What trends are we seeing now as far as appetite for bonds? Perhaps not so much treasuries, but in the private credit area.
Yeah, well, bonds have, I think, objectively been a terrible place to invest for the last several years.
Yeah.
And that's because it's been an artificially stimulated market, and overall, the returns really haven't been that satisfactory. And you've seen that in, as you mentioned, the significant trade-off in bonds over the past 12 months. I think the AusBond index is off around 10%. Global indexes for corporate bonds are off 12%. So they haven't performed their function at all as a defensive asset. In fact, they've actually shown quite a lot of volatility.
Yeah, because certainly at the outset of the pandemic, a lot of investors thought that was the safe place to be, wasn't it?
Well, people love safe havens when things get a little bit tough, and we did see that in bonds. It's funny that effectively what investors have done is that they've bought high and sold low. So they've done the opposite of what you learned in business school.
Oh, that's the herd mentality.
Yeah. We saw, in fact, in the June quarter, some record outflows, or at least for a while, from the Calastone data as to investors taking money out of managed funds in fixed income. So what I'd say about bonds is it's not been a great space. The opportunity set does look better at the moment. Investment grade credit now is sort of trading around the 4% level. High yield credit globally at 7 or 8. These things actually are looking to do what they say they should now. You're actually getting an appropriate, I think, return for risk there. That said, you don't want to just allocate too much into one space, and sometimes to a hammer everything's a nail, and if you're a bond manager you're always going to say the bond universe is good, but I actually think at the moment the returns in private credit relative to the risk you're taking are actually significantly above what still remains available in the public bond universe, and you don't have the same level of volatility.
Speaking of private then, let's take a look at what's going on in the super sector at the moment. That debate, I guess, about investment. Some well-performing, well, those super funds that appear to have outperformed have been choosing private investment over public. Why is that? And do you see that trend continuing?
I think the trend will continue because I still think that the allocation to private and unlisted assets for Australian super funds lags what you see from global pension funds and global endowments. And you're right that the better performing funds in the MySuper dataset in the last year have certainly been those with a higher allocation to unlisted assets that haven't been exposed to the same level of volatility as public assets have. I think the important thing here is that price and value are not the same thing. And the fundamental value of the assets in a fund can actually differ from where the price performance of those assets are. And so I think unfairly, a lot of super funds who do have exposure to whether it's private credit, private equity, infrastructure and unlisted assets have actually been unfairly maligned in this environment with people saying, they're marking their own homework, they're coming up with these valuations in a spreadsheet. In reality, if you are a long-term investor, as a super fund is able to be, I think you actually want to be in private assets because it enables you to take out the short-term voting machine effect, if you will, of markets and focus on the long-term fundamentals.
What sort of private assets though? I mean, clearly infrastructure has been popular.
Look, infrastructure continues to benefit from a range of tailwinds around government spending in that space, and I think that that is an attractive space to invest. We also really do like the world of private credit, and that is asset-backed lending, even lending to corporates, taking share really away from the banking sector and putting it into types of investment vehicles like super funds that can take a long-term fundamental view about that type of asset or that company. And again, the returns there are particularly attractive relative to the risk you're actually taking, which if you do it right, I think can be low. You've got to be careful though.
Yeah, well, absolutely. Are most Australian super funds concentrated purely in Australia, or because I often see news of, for instance, Canadian pension funds looking at Australian assets to invest in? Is the reverse occur?
You do see the reverse occurring. I'd say probably you could take two views. Perhaps not enough in that there's a huge global market out there and Australia is a very small component of that market, so you don't want to shut off a large part of the investable universe. The counter argument could be that actually we've got this huge pool of capital and it would be great for that capital to be invested in Australia, to create growth here, to fund businesses here, to compete with the major banks who've had an oligopoly in this market. So I think you actually do need quite a balance there, and what I think would be great is if you saw that pocket of capital really start to compete with Australia's major banks in the direct credit markets in Australia. It would be a huge benefit, I think, for the economy.